Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, the maximum risk in this particular example is $300, is $3 per contract, or $300. Now, right now we're looking at a price chart of the CDD as it's sat today. Now, there are a number of reasons why we might be rationalizing a move to the upside. Now, this information here, as you can see, is essentially referencing the call option position. But from a technical perspective, one thing that we've been looking at in the FX options outlook that we've been publishing for quite some time now is the idea that the U.S.-Canadian pair has been trading off of this par level or this 100 level for quite some time. In fact, this particular snapshot of the chart doesn't do it justice because there's been a number of different tests of that level for quite some time. So the outlook was that a break above this roughly this 101 level opens the window for a possible move to the upside. So with that in mind, what we could conceivably do is we could go in and we could buy these call options to participate. Well, in this case, we're looking at the 101 strike call options, and those call options, in fact, we're trading, or 101.50, we're trading at $3 per contract. What we have to recognize is that if we hold this position until expiration, we have a break-even point of 104.50. So what we're doing is we're adding the $3 premium to the strike price of the call option that we've purchased, and on expiration, the underlying pair has to be above 1.50 in order for us to be profitable. But that being said, if we consider the volatility factor, if the move starts to take place very quickly, remember that we have a number of different variables that are influencing the options premium. So if the move starts to happen very quickly, we're going to be profiting based on the delta because your ISE-FX options also have a delta. These would be at-the-money option contracts, so we would expect that these options would have a delta of approximately 0.50. In other words, for every full point that the index moves, or that the pair value moves, we would look for a 50% or 50-cent move in the actual option contract. We would also have an influence on that premium through an increase in implied volatility. So what this allows us to do is it allows us to start profiting as the pair value starts to move in our favor. We don't necessarily have to hold it until expiration, but we do have to recognize that there is a break-even point if we do hold it until that particular point in time, that the index has to be above, or the pair value has to be above, in order for us to make money. Now, you can see here that the entered trade would be quite simple. We'd be looking to buy one CDD March 101.50 call option. This gives us all the way out until March, in fact, to participate. And this is going to cost us $3 per contract, but when we do our multiplication, you can see that it's going to cost us $300. Now, there's a quick question here. To buy certain strike price at 104 or 101, do we look at the open interest or delta, or just the options? I think your reference is not the stock options, but pair value options. The idea, and this is my particular approach to utilizing options, doesn't matter whether it's in the currency markets through these FX options or whether it's in the equity markets, is that as long as the spread differential between the bid and the ask is relatively close, which I know for a fact that the market makers for these particular options work very hard to keep the spreads very reasonable, I'm not so concerned about the open interest because I know that there's a market maker on the other side of the trade that is creating a bid and an ask price that they're prepared to do business through. So what I would be looking at is not so much the open interest on a particular strike price, but more so, is that strike price positioning me in such a way that I can, that I'm really in a position to profit with the highest probability. So my general rule of thumb when I'm buying options is I want to give myself at least 3 months to participate, and I want to choose a strike price, be it whether it's a put or a call, that is close to where the underlying security is trading at presently. And my plan is also not to hold it until expiration. So in this case, although my break-even point here would be 104.50 on expiration, as soon as I get into this trade, as soon as it starts moving in my favor, I'm going to start locking in profits and offsetting some of my position to make sure that I don't turn a winning trade into a losing trade. Now the idea here is that you can see no matter how low the pair drops, we in fact are looking at a maximum risk exposure of $300, whereby we have an unlimited profit potential as the pair continues to move in our favor. Now these numbers reflect the position on break even, so we really have to keep that in mind. But just to give you an example, if the pair was sitting at 106, which is a little bit more of a reasonable expectation on the options on the underlying here, then we would for our $3 trade, we would be profiting about $1.88 or almost $2 for that contract. So we would what this is reflecting is getting our $3 back plus getting a $1.88 in profit. So this is the consideration for this, and just a great comment that Steve's making is, really just look at the bid-ask spreads, as I mentioned, rather than the open interest, because it's really the market maker that you're doing business with, not everybody else that might be positioned in these particular options. So make sure that the spread differential is something that's attractive. 5 to 10 cents, or 5 to 10, cents is what I would be looking at. Now, with that in mind, one might be considering, as I said, if I go back to this chart, the idea that maybe that 104.5 break-even point might be a little bit too high, and when we consider the fact that we're putting up $3 per contract, we also might be stepping back and looking at the fact that, well, maybe it's a little bit higher of a premium that we would be prepared to pay. So with that in mind, although I suggested when we looked at the implied volatility for the CDD that it wasn't unreasonable at this point, I want you to keep in mind this next strategy for taking advantage of a directional bias during periods where implied volatility is high. So in other words, what we're trying to do is we're trying to offset that cost of implied volatility. We're trying to take volatility out of the equation as effectively as possible. Now, one of the greatest ways to take advantage of that, and very simple way, is to utilize what's known as a debit spread. So, for example, when we're looking or considering the implementation of a debit spread, we're going to have the belief that the pair value is going to move in a specific direction. So, in other words, we're going to have a directional bias. Let's say, for example, we think the CDD is going to move higher, but we think that the option contracts are too expensive. So we want to be a buyer, but we're thinking that the option contracts are too expensive. Now, the other rationale behind using this strategy is that we might have a limited account size. So we might be looking at creating a position in this particular and taking advantage of this particular scenario, but in order to do so, we might be allocating, we might have to allocate more capital than we're prepared to do so. So a debit spread is a great way where you can lower your cost basis, you can lower your risk exposure, and while at the same time profiting in a specific market direction. So the idea is that we're going to buy a call if we're bullish, we're going to buy a put if we're bearish, and we're going to sell a further out-of-the-money option contract to offset the cost. So in other words, while we're paying for the increase in implied volatility as the buyer, we're going to have somebody else help us out by collecting a premium and having them pay us for a premium that has the implied volatility factored into it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.